Retail inflation print has come in at 6.77% for October. That's a 3-month low. Earlier today, wholesale inflation came in at the lowest we've seen in nearly 17 months. Joining us to share her thoughts on today's inflation print is Aditi Nayar, Chief Economist at ICRA. Ma'am, thank you so much for taking time out.
Thanks, Pallavi.
So, to begin with, is it fair to say that today's print was pretty much in line with your expectations and has consolidated hopes for the MPC to to hike rates by a smaller pace than previously?
Yes, Pallavi. The CPI inflation data has come in just about 7 bips higher than our expectations. We had penciled in 6.7% for this month. And the WPI data has actually come in 40 basis points lower than the 8.8% that we were forecasting for the month of October. So on the whole, I would say that clearly inflation is now going to be trending downward. Over the next couple of months, we expect it to be in the range of 6.2% or below for the most part for the rest of the fiscal year. And I do think that this is setting the stage for the Monetary Policy Committee to be able to reduce the quantum of the next rate hike to, let's say, about 35 basis points from the 50 basis points that we've seen over the last few months. I would still say that there will be a rate hike because inflation on the retail side remains well above that 6% upper tolerance band. And the strength of the GDP data that we'll get at the end of this month for Q2, that will also play a factor. We think that the Q2 GDP data is probably going to be a little bit stronger than what the MPC is projected. So I think 35 basis points seems to be a fair quantum of a rate hike in December. And after that, there's just too many things at play, so possibly highly data dependent call for February.
All right. Coming back to WPI inflation, since we've seen a single-digit print after a fairly long period of time, does it also sort of provide hope that retail inflation too will continue to ease in the coming months? Like how well does today's wholesale inflation print bode for retail inflation?
See, the WPI inflation is extremely sensitive to global commodity prices and also to the rupee depreciation, whereas the CPI basket is less sensitive to these factors. Firstly, we have to remember that the CPI has a much larger weight of food than the WPI. So, what happens with domestic food prices is very, very crucial as far as the CPI trajectory is concerned. And right now, we've got a couple of conflicting factors over there. We had the unseasonal rainfall in early October, which is hurting the prices of perishables and pushing them up. On the other hand, we've got a brisk start to Rabi sowing that has taken place so far. And actually, a fair bit of last year's area has already been covered. So we've got, sort of different factors that are going to be driving the food price outlook. But on the perishable side, I think we do need to remain a little bit cautious in the immediate term. And therefore, that is something that is going to guide the food inflation outlook, which really dominates the CPI. When prices fall for commodities globally, that quickly translates into a downtrend in the WPI inflation, but it may take a little bit longer to really move into the CPI inflation. One more factor is there that the CPI inflation, about a quarter of the weight is services. So, like what we saw today, within the miscellaneous items, the inflation, the YOY inflation for services like education and health inched up. Now, that is something that again is a very domestic oriented factor. And since we're expecting a robust demand for contact intensive services going ahead, services inflation is something we need to remain watchful of.
Right. You have indicated even in your previous research notes that services inflation is something that needs to be watched out for in the coming quarters. Along with that, cereal inflation too appears to be fairly sticky, along with a bunch of other items, maybe spices, for instance, I believe was at pretty much the highest since we have data for since about 2014. So, I mean, would you say that there are, despite the fact that there are indications of easing, you do expect a lower print next month as well, there are enough risks to the inflation print going forward?
there are enough reasons to remain cautious. Let me put it that way. See, within cereals, we have two now again differing trends. The wheat output was affected by the heat wave, and wheat is only going to be sown now. So, wheat arrivals are going to be there in the markets several months later. So, until that happens, there may not be a meaningful softening in the wheat prices, for example, unless we start seeing a very large jump in the wheat sown area. So we're at least a few weeks away from even a hint of that sort of a positive sentiment for wheat coming in. And on rice, it's going to be the rivals from the the Kharif crop, which are going to matter. So there, let's see how the trends move. But I would imagine that wheat to see any kind of good news is still going to take some more amount of time. One more factor is there, for next quarter, if the free food grain scheme is not extended, then maybe that is something that could have an impact on the market prices as well.
All right. So, moving to, we saw industrial production figures coming in on Friday, and that was better than expected. At the same time, we have seen, outlook for GDP for the full fiscal, a more cautious outlook considering global growth impulses continue to weaken. So, all in all, how do you see things panning out with the festive season behind us? What are high frequency indicators looking like right now?
See, honestly speaking, we were a little disappointed with the IIP data because it trailed what was indicated by the GST e-way bills data for September and also for October. Considering that we had a lot of holidays in the month of October, we still had a positive YOY growth in GST e-way bills, and I think that is possibly giving us a more real-time indication of how things are moving in the Indian economy as compared to the IIP, which is a very dated base. So it's sort of, there's a lot of exclusion which is happening in the IIP. So I would possibly place more stock on the GST e-way bill data than on the IIP data. I think Q2 GDP growth is probably going to have been slightly higher than what the MPC was projecting. The festive season, to my mind, to anecdotally what I've seen around me, I think has also been healthier than what we were expecting. But now the big question is what happens to exports, and we're waiting to see the October merchandise export data, which I guess we'll get in a day or two, to understand what kind of an impact three forces have had. One, the global economic slowdown that we're seeing. Secondly, the impact of lower commodity prices on a YOY, maybe not on a YOY basis, but at least sequentially commodities have eased off a lot. And the third impact is the fact that INR may have depreciated against the dollar, but it's appreciated against many other currencies. So between these three factors, how much of a negative impact is coming through in the month of October itself? Again, we have to keep in mind October had a lot of holidays. A lot of factories would have been, taking a break during that month. So even if we end up with a bad print for October, I think that's something we need to keep in mind in terms of looking at the outlook for November and the rest of the fiscal year. So overall, I would say that that's the biggest downside at this point in time to the growth outlook. Incidentally, as of now, we have not changed our forecast down from 7.2%, which is what we've had since the Russia-Ukraine war started in March. And festive season, I do think, has been better than our expectation. But now, really, the question is how much is the global slowdown going to clamp down on our exports?
Right. Considering that the festive season is now behind us and global growth impulses are visibly weakening, what's expected to drive growth in the coming quarters?
See, two things. One, we need to see how much of a spending diet consumers take after the festive season. I suspect people have overspent because we just had this great pent up demand for festivities after 2 years of lockdowns and really a sort of fear factor. So possibly people might have overspent and we might end up seeing a little bit of a slowdown before things normalize going ahead. But what can drive growth in the second half of this year is higher capex, particularly by the state governments. Our analysis shows us that there is a huge headroom and fiscal space available for state governments to be able to spend on capex. The outcomes in H1 weren't that enthusing, so let's see if there is this back-ended sort of pickup after the monsoon finished.
All right. That's about it at my end. Thank you so much for taking time out today.
Thanks, Pallavi.
Stay close to the